Hey guys, in today's video, I'm going to show you how to create financial statements from scratch. And I figured that the best way to do this is to go through a business from its inception, or the moment that we started the business and funded it with the initial investment. And so what we'll do is we'll look at the initial investment into the business and how we account for that in terms of journal entries. And then we'll look at the initial transactions in month one and then prepare the journal entries for month one as well as a trial balance, and then go through the flow of how the data flows from transactions to trial balance, and then from trial balance we'll take it into summarizing it into financial statements. So I'm going to show you all that in today's video, and if this all sounds good to you, give this video an early like so that it reaches as many people as possible. And without further ado, let's jump into today's video. Make sure to download our balance sheet metrics cheat sheet. It's 100% free and an amazing resource, especially if you're a financial professional, finance student, or into stock investing. I'll leave a link in the description, so go ahead and check it out. And again, it's 100% free. It includes a set of financial statements and the financial metrics along with their purpose, formula, calculation, as well as the explanation of why the ratio is either good, poor, etc. All right, so let's look at what kind of transactions are happening at the beginning of a business. So at the start of the business, you are investing $100,000 into the business as an equity. So this is your equity initial investment that you're putting into the business. And then in month one of the operation of the business, to get it going, you hire some staff. So let's say you hired 3 staff members and the initial month of salaries is $15,000. You also bought some office supplies for $2,000. Furniture, which is maybe desks and chairs and things that you need to operate the business, $2,000. PCs, assuming that you are buying, 3 of them one for each staff member, that's $3,000. And then we'll assume that you spend on marketing $5,000. Maybe things like online advertising or some maybe print marketing material as well. And we'll assume that in the first month as well, you generated $30,000 in revenue. So now what we'll do, we'll go ahead and create journal entries from these transactions. And the way we're going to create the journal entries, we'll use our visual aid here, or our acronym DEALER, DEALER. And if you haven't seen my video on how to record journal entry, I'm going to leave a link to it up here. Basically, this is the acronym that I use even up until today, after 15 years in accounting, to remember my debits and credits. And basically, the acronym is DEALER. D is for dividend, E is for expenses, A is for assets. And the other side of it, the credit side of it, is liability, for L for liability, E for equity, R for revenue. And obviously, every transaction will have 2 sides, a debit and a credit. Basically, it's not necessarily good or bad to be debit or credit, but it's just to record the dual nature of any transaction. So any transaction has 2 sides of it to represent the economic benefit of that transaction. Say if you have a payroll expense, on one side of the transaction you have debit to payroll expense right here, so E for expense will have a debit nature, and then cash will be on the credit side to represent the economic value that you're giving up cash and getting a service from the employee in return. So that's why you have debit and credit to each transaction. So we'll use this visual aid here, DEALER, to go ahead and record our journal entries. And so what we'll do is we'll begin with the initial investment of $100,000 and record that into journal entry. So basically, as you invest money into the business, this becomes your equity. So basically, this is money coming into the business, $100,000 coming into the business. So you're recording in the cash journal here, $100,000. And the way to know whether it's debit or credit, you may already know this if you've done this before, but basically, you look here, you see in the dealer model, asset, and cash is asset, and it's a debit to increase it. So basically, you record $100,000 on the debit side. And then for the credit, we said that when you are bringing money into the business, this is your equity. So this is recorded in the form of paid-in capital or additional paid-in capital in this case. So the credit will be to additional paid-in capital, and always credit will be on the right side and debit will be on the left side. So the credit will also be $100,000. So now we've recorded our first investment, or the initial investment, into the business. Now let's go through the transactions that we have and record them as well. So we have salary for $15,000. whenever you're spending any money, and if you want to decide as an accountant, you want to decide if that's an expense or an asset. If you're spending money on a salary, the way to decide if it's an expense or an asset is if there's a future economic benefit from that purchase. So this is a salary, and basically it relates to the month that we're in. You receive the service from your staff and you're paying them a salary. So basically it relates to the month that we're in, so it's an expense. But if you are spending on any kind of expenditure that has a future economic value, that now you're buying an asset. But in this case, this is an expense because we are simply paying for the service rendered in this month. So this is an expense, and if we look here, expenses, to increase them, they have a debit nature. So to debit that will be $15,000 debit to salary. And then the credit, because the cash is going out, so you're getting the service, $15,000, but the cash is going out. So cash, when it goes out, you'll be in the credit side, the opposite as when it comes in. So that would be a credit, $15,000 for payroll. The next transaction is office supplies. So now we are buying office supplies for $2,000. And again, think of it the same way. If you're spending $2,000 to buy office supplies, is that an expense or an asset? Is there a future economic benefit from getting office supplies? Yes, there is. So you're buying office supplies today with the purpose of using it over time. So there's a future economic benefit, and it might even last you for a whole year. So basically, this is going to be an asset. And so an asset is here on the model. It will be a debit to increase it. So office supplies, which is right here, will be a debit of $2,000. And again, with cash, because you're spending in cash, cash is going out, so it's a credit of $2,000. The next item is going to be furniture. So you're buying some desks and chairs for your staff for $2,000. And again, you can think of it the same way. Basically, you have $2,000 going out for a future economic benefit. So that's an asset. So furniture, we recorded the same way. It's a debit, $2K, and a credit to cash for $2K. Great. All right. Up next, PCs. So we're buying 3 PCs. Same concept. You're buying the PCs. You're spending the money. It's not an expense because it's not only for the period that we're in. It's for future economic benefit. So same way for PCs, $3,000, which will go right here. PCs. So 3,000 debit. And credit to cash for 3,000. Up next, we have marketing expense, $5,000. Now with marketing, sometimes it depends whether you're spending this marketing for a future, let's say it's a prepaid, like maybe a marketing platform that you're prepaying into for a future consumption of that pay, or you are spending on a service that got rendered in the month. In this case here, we are spending $5,000. We're assuming that it's rendered, the service already has been rendered in the month, so it's a fully expense. So that one, it depends. You gotta be careful whether the marketing expense is for future benefit or already something that's already got consumed. In this case, the marketing service has been consumed, $5,000, so it's an expense. So when we look here, expense have a debit nature, so to increase them will be a debit. So we'll go to marketing and we'll record a debit of $5K. And we'll record the cash credit, cash going out for $5K. So now we recorded the debit and credit of that transaction. So now we're done with our expenses, and we're saying that in the same month we generated revenue of $30,000. So the way to record revenue, looking here at our dealer acronym, revenue is down here in the word dealer, it's a credit. So to increase revenue, it's a credit. So you look at revenue, which is right here. So that's a credit of $30,000. And you can guess where the debit will be. It depends, I guess, if you are receiving in cash the entire amount from your customer, or you have an accounts receivable at month's end. In this case, we'll assume that it all got received in cash. So that increases our cash. And when cash is increased, it's an asset. To increase it is a debit. So that will be also here a debit of 30,000. So now that we've recorded all of our transactions into the form of journals, we can go ahead and sum each T account. These are referred to as T accounts because one side of it is debit and the other side is credit, and it's just a way to record a journal entry in a visually easy way, just to see where your debits and credits are at. So what we'll do is we'll sum each account in these accounts here, and then we'll transfer the summation of each of these accounts into a trial balance, so that we can make sure that it balances. Obviously, from the name, trial balance, you are trying out whether the accounts will balance, because if they don't balance, it means that you misrecorded one of your entries here. When they balance, you get a good indication that your accounting is right, but it's not 100% because you could record one of these entries in reverse and still have an equal debit and credit at the end in trial balance. But it will give you at least some comfort that your journal entries are correct. And then the rest of it is that you do a bank reconciliation. When you do a bank reconciliation, you'll know whether you missed anything in your expenses or not. So 2 steps that you normally do to make sure your accounting is right is to create a trial balance out of your journal entries, and then secondarily is to conduct a bank reconciliation where you agree your cash balance a month end to the bank statement to catch any other mistakes or omissions that you might have made. So we'll go ahead and sum each of our T accounts here so that we can transfer the balances to a trial balance. So for cash, in the debit side, we have 30 plus 100, that's 130K. And on the credit side of cash, we have credit 15 plus 2, that's 17 plus 2, 19, plus 3, 22, plus 5, 27K on the credit side. So we can transfer that balance over to our trial balance. So basically, it's a debit of 130 minus credit of 27. That means a balance of 103, a debit of 103. So you transfer that over here, 103. And you do the same thing basically for all of the other accounts. So APIC has only one entry, credit of 100K. So that would be 100K. On the credit side, you transfer that here, APIC, 100K on the credit side. And this is going to be all in thousands. And then for revenue, credit 30K. So that's a balance of 30K credit side, revenue 30. And then you have salary 15 in the debit side, so that's a 15K when you sum it. So 15K salary, you transfer that as well. So 15K for salary on the debit side. And then you move over here, office supplies 2K debit side. So office supplies 2. Furniture, we have a debit 2K, same thing. So that will go in furniture here. We have PCs 3K, PCs 3. And then we have marketing 5K debit total. So marketing 5K, which will go right here. Now, to check whether both sides of debits and credit will balance, you just add them up. So on the debit side, we have 103 plus 2, that's 105, plus 7, plus 2 is 107, 110, 125 plus 5 is 130. And credit side, we have additional paid in capital 100, plus revenue 30, that's 100 plus 30 is 130. So that tells you right there that your entries here were correct in terms of debit and credit. To be sure, you would you get a bank statement and compare the balance on the bank statement to the cash balance here, 103. Make sure that's correct, and that will give you additional comfort that your entries were correct. So what we'll do is we'll maybe make some space on this side. Okay, ready? So now what we'll do is we'll take the balances from the trial balance that we made sure that a balance is there, and we'll take the balances and summarize them in terms of income statement and balance sheet. So basically what we'll look here at is revenue. So what's our revenue here from the trial balance? We have 30. So revenue, and this is also going to be in thousands, 30. Expenses, we have salary right here of 15,000. We have marketing expense, 5,000. Total expenses of 20,000. And the net income will be revenue minus total expenses. That would be 10,000. Now, when we look at the balance sheet, basically we summarize in terms of assets, and then so the two sides that were balanced is one side assets, the other side is total liabilities and equity. So basically assets, we have cash right here, 103. Office supplies, 2,000. PC and furniture, so we're going to sum together furniture and PC in one line item, so that would be 2 plus 3, that would be 5. That would give us total assets of 103 plus 2 plus 5, that would be 110K in total assets. Now, in the other side of the balance sheet, we have liabilities. In this case, we don't have any liabilities just by looking at the trial balance. In some cases, you could have accounts payable if you are spending some of your expenditures on credit. But basically, in this case, we paid for it in cash, so there is no liability at month end. Equity will be APIC, or additional paid-in capital, which we have here of $10,000 or $100,000 rather. And then the remaining of the equity would be retained earnings, and this is the area where most people would make a mistake, which is the other side, or what would make a balance sheet balance, because basically if you look at the two sides of the balance sheet, on one side total assets 110, the other side you have additional paid-in capital of 100, which is the initial investment into the business. But basically the remainder is retained earnings, and retained earnings basically is the accumulation of earnings into the business. And so what were the earnings in this month, in the first month of operation? It was the 10,000 net income that we had. So that becomes then retained earnings, which increases the equity of the owner. So retained earnings, that's 10. And so if you add up then APEC 100 plus 10 is 110, which would balance with total assets. And now your assets and liabilities, owner's equity are balancing. So now you have the income statement and the balance sheet, and we went over the flow of data from transactions to journals to trial balance. So if you learned from this video and you liked it, go ahead and smash that like button. And if you know someone else that might benefit from this content, go ahead and share it with them. And I'll see you in the next video.